to improve your 2026 outlook, right? You have to practice what you preach. So to be on one more time this year, we've asked, and Jordan has responded, and he's here today from One America, and we are excited about this because I'll tell you what, out of everything that Clayton and I started off this year, going to the big convention that we went to in San Diego, it was the One America aspect that really got us like the most excited out of everything we saw there. Is like, oh yeah, we're going to be doing a lot more business with One America, and I'm so happy to have met Jordan. The fact that he's that close to Clayton, and it's been a great experience. So thank you everybody for joining us again. Clayton and Jordan, I'm going to hand it off to Clayton here in case you want to take over. I'm just going to be in the background letting people in, Clayton. So I'll let you take the rest off here on this point.
Phenomenal, phenomenal. So, folks, welcome once again to our Friday training session. And I know, Peter, I think we only have one or two more of these this year before we wrap things up. And so, looking ahead at the calendar. And so, the fact we got Jordan on, I'm excited today. Jordan Fields with One America is rejoining us this afternoon to go over some sales strategies that ultimately will help put money in your pocket. And I've been working with Jordan now for quite some time. I went out in the field actually a week and a half ago, and I took a couple of PDFs that Jordan had sent me on the fly at the last second. And so I just confirmed it a moment ago. I'm going back out on Tuesday this next week to sit back down with that client and to go ahead and hopefully get a sale out of it. So, Jordan brings a wealth of knowledge and value, folks. And if certainly you've not had the opportunity to work with him, you will want to. So with
If
that, Jordan,
I could add to that real quick, I got a call
uh,
last night from a client of mine who I have sold over $800,000 in annuities to, and she's like, I'm tired of this. I've got about $263,000 sitting in a mutual fund account that's made less than 1% this year in this environment. She's like, I want to do something else with it. She has no kids, has no other family to help take care of her. So when I pitched it, she's like, yeah, that sounds good. So I've got a piece of business that'll come in next week, 263,000 towards a One America case. So just putting that out there.
Thank you.
good stuff. Well,
Go for it.
look, Jordan, take it over, buddy. You're getting a lot of love here.
Well, I appreciate that. That's the fun part of my job is building relationships like this and helping people have success. I want to kind of not change up, but before I get kind of rolling in the things that I had kind of thought where we want to go today, I want to open it up to anybody on the call today of when you think of long-term care and any inhibitions, challenges that you have. I'd love to hear what are some of the challenges or things that are holding you up from making LTC a part of your business. So you can either unmute yourself, put something in the chat. So I'm watching the chat right now to see if anything's in there. I'd love to hear from you all because don't get me wrong, I have no problem filling the airways with whatever content we need to with the direction I think that makes the most sense. But it's not about what I want to say, it's what you all want to get out of today. So I'd love to hear from you all what you want to make sure, what would be beneficial to help with.
It's such a lively group.
I'd say Ray's probably got something, but it looks like he just took a bite of food there. So, catch you to, he's like, I'm gonna take a bite of food so that way I don't get pinged for giving any response there. It's okay if you guys don't have anything. Do you love LTC? Do you hate LTC? I'd love to hear
LTC
the
is very important and it's not talked about enough. I'll just say
Mhm.
that.
I couldn't agree with you more. And I'll encourage you. So November is LTC Awareness Month. Let me give one last chance for anybody to chime in, and then I'm going to roll here. Going once.
Nobody wants to talk about it until it's too late.
Yeah. Well, here's what I'll actually say that. I think that mindset was much more prominent 10 years ago. Where it's at right now is people need someone to help initiate the conversation. because your clients want to talk about it. It's not like what it was 10 plus years ago. Because 10 plus years ago, you weren't seeing as many people around you having the care events. Well, now for all your clients in their 60s, they're not only seeing mom and dad need it, but they may have seen some other people around them having care events. So it's not like, nah, this isn't going to happen to me. Like, okay, I probably need to have a conversation about it. But it's kind of like eating your vegetables. Until someone pushes, creates that pain, creates that sense of urgency, it's going to be usually when clients bring up LTC conversations, it's too late. Oh, I just got
Yeah,
diagnosed with Alzheimer's. What can I do now?
I
Um,
I had I'll be speaking to some church representatives tomorrow, and my focus is will be on longevity planning. Um, you don't always have to be old to have a need to, an accident can put you in that position. There are different things that can cause you to need care. And
mhm.
so I think, shifting, and a lot of people I know, even they're older, they have great health, but you never know when you have a stroke or a heart attack or whatever. I had one, didn't have any normal symptoms, and I'm going, I didn't see that coming. So, getting that message out to people and letting them know, um, it's all about the planning for the what ifs. And so,
Completely agree. So I'll give you some effective tools. Some of this will be very timely. Um, Ray asked the question. Well, he stepped away, so I'll come back and plug that in. November's Long-Term Care Awareness Month. And typically, when I talk to advisors, um, I tell them there's 3 times that I would market LTC solutions at a minimum: November, April, and client reviews. Client reviews are the easiest when you're just reviewing plans. So you're just saying, hey, we've talked about this. We want to make sure we go revisit this. But here's why November and April: Thanksgiving and Easter. Thanksgiving kicks off the holiday season. Easter's the first time we're getting back together after the New Year's. Those are 2 of the biggest time periods where people either file a long term care claim or go to a nursing home. Here's why that's important. There are 3 reasons why a client will implement a plan or change. One is they're emotionally motivated. 2, they come into assets or resources that allow them to implement a plan or change. 3, they get educated. And the last one is what most advisors have done for LTC. They find a great client prospect, they pitch this opportunity, it makes perfect sense. There's no reason that they won't move forward, but the client goes, "Yeah, let me think on this." And that just turns into never. And it's not that it was a bad solution, it was bad timing. So that's why I'm going to encourage you all to work harder, not smarter. Or sorry, to work smarter,
Hmm.
not harder.
Hmm. Whoops.
Yeah, but so I'm going to share with you this piece. Share. So if you see me looking over here, I got you all moved to this screen now. Go here, and I have to click the share button. That would help if I did that. Go here, swap. Can you all see my screen okay?
Yes.
Absolutely.
Okay, so this is hands down my favorite marketing piece that we have. And one of the reasons why I love this is it does not talk about the products because the products are not what's important. What's important is you letting your clients know that you can help them with LTC solutions. And one of the best ways to help drive those conversations is not to pitch a solution to them. Give them something that's helpful. And this piece, what you're seeing right here, is a plan of care. I'll argue that this is just as, if not more important than a will or estate plan. Because think about what a will or estate plan is designed to do. It says, if you're no longer here on this earth, what do you want to have happen? Well, what a plan of care says, if you're no longer here or you're only here mentally, what do you want to have happen? Because if you don't have that spelled out, there's typically 2 people that are going to make those decisions for you. The first one is the loudest family member. The second one is the government. Think about how scary that is. Most people do not have a plan for care in place. So I love, 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 push this out. Here's how I would handle this. I would share this piece with all of your clients and prospects in the month of November, and I would try to do it at bare minimum a phone call to all of your A's. Just saying, hey, just November's long-term care awareness month. I have a lot of the people I work with who are experiencing family members needing care. Just wanted to share this piece that can help you with productive conversations. Here's some
Hey,
things that I
Jordan,
like
can you
about this.
blow that up if you don't mind for Ray?
Yep.
I didn't want to jump in and interrupt you, but
So let's
if
do
you could
this.
have go back and just had zoom in for a little bit more on that first piece there.
And I'll send a hard copy of this to all of you so you have it. And I'll also include a video of me
Cool.
recapping this exact everything that we're talking about here. So my background, I'll tell my joke. So my background is I used to be a high school math teacher as well as an advisor in personal production. Been in the financial realm for over 15 years. So usually when I tell people that, they're like, "Did you start when you were 12?" It's like, no, I gotta thank my old man for my baby face. So yeah, plan of care. This first half of this page, nothing too significant there. Basics, client info. But when we get to the top of the back half, this is a part that I like here. Not to gender typecast the conversation, but when you typically think of your audience, women, they're going to understand the need for planning for care, partially because they've historically been forced to be the care provider. Men, we're big dumb idiots. We don't think this is going to happen to us. So I love painting this picture of saying, okay, if you did have a care event, how are we going to pay for it? And here's, hang on, I'm sorry, that's my fault.
Quick question. Do you have these materials in Spanish?
I don't know if we have the plan of care piece in Spanish, but I will definitely look that up for us. I'll put that as my follow-up piece.
Okay, thank you.
All right, sorry about that. I just collapsed my computer. Let's make sure that everything's back. Can you all see my screen okay? Is this back to normal now?
Yep.
Yep.
Okay. So I owe that to Surface Pro for where they hide the pen on the tablet. I had to dig under my keyboard, and that's why my mouse fell backward. My whole thing collapsed. So here's something I would use on a legal pad when I'm chatting with a client to help them visualize what self-funding looks like. There's nothing wrong. Where did pain go? So one of the things my computer likes to do is shrink that. Where did that go? There we go. It's just hiding behind something else. So one of the things that I like to do from a visual standpoint to help a client understand what self-funding is. So think of it like this. Your client has one of 4 buckets that they can pull from in order to create a dollar's worth of care. That's what's on the right here. And so when you walk them through those clients that feel like they can self-fund a long-term care event, does it make sense to pull from $1.30 to create a dollar's worth of expenses? No, because you're losing 30 cents to every dollar. What about $1.15? That's a little
No.
better, but not much better. Dollar for dollar. That's going to be, it's okay. But that 33 cents to a dollar, yeah, that's the way that we want to go. What we need to help educate our clients on is helping them to understand what those self-funding pieces look like. So here's we go back and explain what are those different pieces for that visual there. So that $1.30, that's our IRA. We're paying taxes on every penny that we pull out. $1.15 is our brokerage. Dollar for dollar is cash. And that 33 cents to the dollar, that's a LTC insurance plan there. The catch, if you will, is you got to put that plan in place today. You can't do it on your way to a nursing home. You've got to be proactive about that. So again, this is a great way to help clients visualize what self-funding looks like and if it actually makes sense to their portfolio. So this is how they're going to actually write it out. And then that's what asset-based LTC is all about, is saying, well, how do we basically say, well, what if we could do this better? Part of what makes this such a a advantageous conversation is the LTC conversation. It's not just about the leverage on our dollars. It's not just about the access to the claim concierge services. It's also tax strategies. And your highly financially affluent clients, that's what they're interested in. That's a big piece that they're interested. You're going to get them saying, "Hey, we can ethically give Uncle Sam less money if you ever touch these dollars. Is this something you're interested in hearing more about?" And what I'll tell you is some strategy specifically tied to maximizing tax benefits to the clients. We've been having a ton of success with. And let me, I'm gonna go. I want to go back because I want to see what. Let me see here. What was Ray's question that he asked in the chat? I apologize. I did not write that down before I jumped at it out of it.
It was just simple. I was asking if there's an average age that LTC really kicks in for the client.
Yeah. And when you say kicks in, do you mean like when they have a care event or for when the solution
Yeah,
makes sense to look at?
well, both when they need it and when do they usually look to.
So let's start when they'll need it. So what you'll hear industry wide is that the average claim age is age 80. But when you actually dive a little bit deeper into those numbers, your financially affluent clients are going to be closer to age 85. The reason being, realize when you compare the general population versus your financially affluent clients, your general population, it maybe isn't seeing the doctor as much. So their life expectancy isn't as high or living as pushed back further as what your financially affluent clients are. They're seeing the doctor, they're getting the hip, the knee surgery, whatever it may be. They're living longer, and you're seeing those care dynamics impact them later on in life. And it's actually more significant from a duration standpoint because of that. Because the type of care needs that are having the biggest duration is more of those cognitive related illnesses. So that's basically what modern medicine has done is made it so less and less people are dying from cancer and AIDS. And because of that, we're seeing more and more of the cognitive related illnesses popping up. And so there, your financially affluent are more susceptible to that. Uh, so answers that number. When it comes to looking at solutions, I would say typically 55 is right about the front end from an age standpoint. You can definitely do younger, but the reason why I say 55 is 55 is the point at which the need for disability insurance is decreasing and you're replacing that with the need for LTC planning. So you're kind of crossing those two waves there. Because 55, you got about 10 years before they hit the max age that your typical DI policy. So your time period that you need to protect their income that they're making versus the income that they're living off of, that's where that focus is. But I'd go back to there's no right or wrong. If someone is in their 40s and they inherited money from mom or dad passing away and they experienced a care event, lean into it. If that's what's important to them, solve that pain point. Take that risk off the table for them there. So no right or so our solutions, we can actually write them as young as age 35 all the way up to age 87. And let me make sure you guys heard that, okay? 87. We can go all the way up to age 87, and we're having a ton of success with that 70 plus demographic. So I will encourage you. You don't have to be the product expert. You don't have to automatically dismiss your clients thinking, yeah, I don't think there's anything out there. Because we could literally have a solution come out tomorrow that offers solutions for clients up to age 99 that's proactive. You just, when you think of your world and what your focus and priorities should be, I wouldn't think it would be the product expert of knowing every single solution out there that exists for every single client. Focus on the opportunity. What's important to the client? What are they wanting to focus in on? Let that drive productive conversations. Thoughts, questions on that? So I want to share with you another piece that part of that plan for care that I love. So what you're seeing on the back of the bottom, this is a front and back piece, is it says, okay, who are the key people that we need to loop in on the plan? Because let me ask this question. How many of you like asking for referrals? Just me? Clayton? There we go. Two. I got three hands. All right. I'll take that. The reason why I love this is what client's going to say no to you saying, hey, your power of attorney, your fiscally responsible kid, do you have any problems with me relaying this piece to them? Making sure that they're aware of what your plan is? No, here's their contact info. Because here's one of the biggest challenges in the financial industry. When you're working with a joint household and the primary decision maker passes away, over 70% of the time, the spouse takes the money elsewhere because they don't have the relationship with the advisor. When the kids inherit it, it's an even higher percentage. So again, it goes back to work smarter, not harder. Keep those relationships in house. Own the whole family dynamic of that. Bring all that in so that way you're not having to go rebuild your book of business when these clients pass away. It goes because here's the reality of it. If I asked all of you, could you all commit 1 to 2 hours a week on LTC prospecting and conversations? Most people are going to laugh me out the door. They're like, Jordan, I have negative time. I'm trying to cut time out of my week. That's why I go back to working smarter, not harder. You worked hard to get these relationships, keep them. And you know what? When you're sharing this plan of care with all the kids, the power of attorney, they're going to be like, well, why hasn't my advisor done something like this for me? I don't know. Maybe there's some other things that they may be overlooking. Maybe it makes sense for us to have more of a conversation. The reason why I love talking about this piece is when I talk about that legacy business, when the primary decision maker passes away. Advisor out of Kalamazoo, Michigan goes, Jordan, I have 100% retention rate. And it's because he talks about long-term care planning with all of his clients, because this is one of the most sticky products, whether you think of it as an insurance or an investment type product, one of the most stickiest solutions out there. And it makes such a strong bond with your client that makes them a client for life. This is a very emotional purchase when a client moves into this. So this is a great way to capture that relationship there with them. So I love, love, love how this piece ties in. And I'll highly encourage you, plant those seeds today for future success with LTC opportunities by sharing this with your clients. I want to pause and give you all a chance of thoughts, questions. I'm going to stop the
That
share and
was
see.
excellent, Jordan. That was a great point. And for
Mhm.
everybody on here who's a part of any of our other trainings that go on with estate planning, this should be a part of your process 100% of the time. When you're talking with them about their tree, right? Who the decision maker tree, this is a part of that equation. Why? Because this is the tool that empowers them to keep mom and dad at home instead of going to a nursing home care facility, right? This is the funding mechanism that grants mom and dad the dignity that they want, but they didn't know that there's a way for them to get. So this is that conversation starter to funding the trust, to funding the will in the few cases where that happens. All right. So he just did a perfect layup with everything he just presented here for that process. So if you have people, I know there's a couple of you on here that are doing the Medicare landscape. Hello. He said issue age up to age 87. Every single person, we need to have a conversation because I feel pretty confident saying every single one of those individuals would love to stay at home rather than go to a nursing home facility. Okay. So this is a perfect layup for everybody on this call who's on here right now. They're actively using these particular tools. So this is a perfect mesh. Thank you, Jordan.
And let me share. So for those of you that have not looked
Didn't
in the
get your
chat,
phone number there. What it was
yeah, that's actually what I was going to do there. I was going to make sure you had my contact info. So let's go here. Oop, there we go. But I do need to change this because I do now have a dedicated internal, so I'm not leaning on um, the inbound team as a whole. Her name's Bradley Farrell. She is fantastic. She is highly swap. She is highly competent, and I'm extremely fortunate that someone that I can just say, hey, I need your help on X, and she just knocks it out of the park. But that's my email address, my cell phone number there. Just think of me as an extension with Clayton and Peter. Just happy to help however I can on that. Let me share this because when it comes to here, let me put it this way. If you can let your clients know you can help them with LTC and you get 4 bits of information, 5 and 6 would also be helpful. I'll help you navigate how to handle these type of opportunities. I'll wear whatever hat you need me to. First is age. How old is the client? Second is an idea of health concerns. So we have a fantastic pre-screening process that makes that very, very easy. Third is an idea of funding source. So is that, oh, let me give you another visual here. Perfect. That worked out perfectly. So this is the essence of the One America contract. I just want to kind of point your attention in the bottom left-hand corner. From a funding source, you'll see that we can do lump sums of cash, annual premiums. That could be a 5, 10, 20, lifetime pay. But look at those last three: qualified funds, non-qualified annuities, cash value life insurance. We can darn near reposition anything. But what I'll tell you is the reason why right now is a very pivotal time with qualified funds is ideally with qualified funds, we want to go to our life insurance chassis. Your target age demographic there is clients age 59 and a half to 70. We can do younger, but they're going to run into early withdrawal penalties. We can do older, but 70 is where I benchmark that you're going to run into health challenges. So something to keep in mind, this is industry wide. When you're talking about clients over the age of 70, whether it's traditional or a leveraged life, you're looking at about a 45% placement rate. So the reason why I'm saying now's a great time to connect, and as well as those qualified funds, is maybe we take a strategy where we take a taxable distribution this fiscal year and another one at the beginning of 2026 and use the combination of those to fund our annuity solution, which has more favorable underwriting. Apologize. I think I was talking over somebody when they're trying to chime in. But I'll emphasize this: those last three sorry, let me go back to the 4 bits of information. So age, health concerns, funding source, and 4, what's important to the client. You get those 4 bits of information, I'll help you navigate. Even if One America's not the best fit, I'll say, hey, Clayton, Peter, we don't really make sense for this solution that we're looking at here. Can you help connect with carrier X for this type of solution? This is going to make much more sense for what they're looking for. The 2 other bonus questions that kind of helps more of the specifics and helps influence those gel all those together. I also like to know the net worth of the client, as well as what's the support structure look like around them. Do they have kids? Are they in close proximity? What does that look like there? That will help me understand how important one path is to another. But here's the reality to LTC. We don't have a product issue. What we have is an issue with advisors feeling comfortable letting clients know they can help them with these needs. You don't have to be the product expert. Focus on the opportunity. Let your clients know that you can help them with LTC. Because most of the times what clients, the feedback we get from clients saying, oh, I didn't know you could help me with this, or I didn't know that there was anything available to me. Let them know.
Jordan. So that little red note you got at the bottom there, that's really, really good. Is everybody reading that on the screen?
Let me translate that. So that red note there in layman's terms. So because we separate our plan into 2 parts, it creates some unique tax strategies. So when I say the 2 parts here, I'm focusing here on this part to the right-hand side of it, the pure LTC insurance on the back end. One of the things that's unique is for individuals, we can use HSA dollars, health savings account dollars, tax-free to pay for that portion of the plan. Is that the best place for HSA dollars? Probably not, but it's a great way to take away that objection or find additional dollars. Also, that portion of the plan is tax deductible for individuals. Not anything significant from a federal standpoint. You'll see more of it come up on the state level taxes. Where your big tax deduction opportunities is going to come from is having the businesses pay the premium. This is via key person or Section 162 bonus plans. Here's the 3 quick hitters. You can do great tax work for the business, key person coverage, and the third, this is unique to One America, is you can add the spouse onto the plan. All that in one swoop move. Huge, huge, huge opportunities there. And what I'll tell you is, again, you don't have to be the expert on it. Matter of fact, you've probably heard about 80 to 90% of what I know about the business deduction. We have advanced sales team members that can get into the nitty gritty details there. But I'll tell you, when you uncover those opportunities, buckle up because those are some fun ones there because you're usually talking about multiple cases and big dollar ones there.
So I just like that the HSA. So if a person has an HSA account
Mm-hmm.
and they're not maxing out that HSA account because they've got a pretty healthy standard of living, why not add a asset care? It would be asset care, correct?
You can do it on any one of the solutions, actually.
Well, for a younger individual, I'm just thinking about a younger couple, right? In their
Yeah.
40s or 50s. Hey, I'm still very healthy. I've got money every year at my HSA, and might as well go ahead and deploy a chunk of that to be your premiums for LTC.
Exactly. So
That's brilliant.
a great seed to plant for your early on. Because think about it like this. One of the best ways to acquire clients, especially good clients, is give them free advice. The best free advice you can give any client, max out your HSAs. It's one of the best investment vehicles because it's the only thing that can hit the trifecta from a tax standpoint. It's pre-tax money. You're going to lower their taxable income. It's going to grow tax deferred, and every penny will pay out tax-free from a qualified expense standpoint. And I'm willing to bet everyone's going to use every penny out of their HSA because you can't tell me they don't need sunscreen or Tylenol for headaches. Everybody's going to need it for something there. There's plenty of qualified expenses for HSAs.
Believe it or not, I've had a lot of clients that don't. They wind up getting all the way to Christmas and they use the HSA money to buy Christmas presents because they didn't use it in the course of the year. I know it sounds crazy, but it's like, hey, now they got something else to go back to those people and say, oh, well, I'm now you can put it into an LTC.
Exactly.
Use it to fund your future. That's awesome.
Yeah. And what I'll tell you, especially for your younger clients, just plant that seed for future LTC sales. Let them build up that nest egg of HSA dollars. Because one of the things I found interesting was during the 2011, 2008 through 2011 financial crisis, one of the things that they looked at there was it wasn't that sales were down. It was more so that it took more touches to get the same sales. So when people are going through hardships, you just got to keep punching, keep punching. And one of the best ways to do that is keep planting seeds with the HSA. Because you're setting yourself up for future sales. Earn that business for the future. I don't really want to make this too much more complicated than what it needs to be. What I'll tell you is the best thing you can do is go have conversation. Plant those seeds that will have value and sales opportunities that come to fruition in the future. And what I'll say is whatever challenge, obstacles, issues that you may have, please don't hesitate to share them, whatever that may be. Because for my world, I support all the advisors in my geographical territory. So I try to eat, sleep, and breathe like an advisor. I try to think from a prospecting, a conversation standpoint, what tools and resources would be most beneficial. So don't hesitate to ask of saying, hey, Jordan, do you have something like this? Or here's one of my holdups. How would you handle this? I have tons of resources. I just don't want to overwhelm you with too much stuff that it's just going to get, overwhelm you and what have you. So that's why I say start out with this plan of care piece. That's going to be a great starting point as far as having conversations with your clients, especially when you're coming in providing value and not try to pitch them a solution because nobody wants to be sold to.
How many people, just out of curiosity, have had to do death claims this year? Anybody else have to do death claims? I think Clayton has. Anybody else? Okay.
Yes.
When you were sitting down with those people this year and you were doing a death claim, a delivery of a check, did you immediately pivot to the LTC when it's prime in their minds about the cost of the end of life care?
Well, unfortunately, the death claim I did, he was 49. The wife was 44. And pretty much they had a financial advisor. It was some friends actually, and they had a financial advisor. She wanted to keep, it was $1 million policy. They wanted to keep everything with the financial advisor.
Understood in that case. But I think, I mean, bring back up that slide again there, Jordan, if you could, the one you just had,
Sorry.
because I think that that was really, really important. Um, I try and encourage everybody. Look, these slides, there's details he has in here, right? Read the fine print. That's your job as the professional, right? Read the fine print. Um, I think that that was a really good. I mean, the two things I saw on this on that slide were the HSA and also the um, where it
Tax
says
qualified.
inherited, right? Where we've got inherited money, or
Mhm.
inherited means somebody passed away, right? So if we've got inherited 401k money or qualified accounts, it should immediately raise that radar to have a discussion about this because it's going to be prime time in the minds of the clients. They just watched their loved one go through this time. It would be the optimal time to present, hey, why don't we take some of that money and make sure that you don't have to do that now that you don't have that loved one in your life to be able to take care of you.
Mhm.
Now's the time to make sure that we can take some of the money that they set aside for you to make sure you're taken care of, right? It's just an optimal time to really present that presentation.
That's
Uh,
an inherited IRA.
so we
You
can
do
actually,
inherited IRAs.
yep, actually use inherited IRAs to fund our plan. So those the case that Glenn was talking about, the 40-year-olds, you could actually use the inherited IRA to fund our solution. So if they don't, let's say they wanted to use a portion of it for whatever, vacation or whatever to remember mom or dad experience something like that, they could say, well, I don't need this portion of it. Well, what if we could solve you and your significant other's LTC solutions with that? Is that something you'd be interested in hearing more about?
That's
And
interesting. Yeah.
yeah.
Well, and then that's only for inherited by the spouse, correct?
No, so it can actually be non-spousal inherited because the way that we handle the qualified funds, we basically take distributions out over a 10-year time period. So we follow the
Okay.
new spousal and non-spousal inherited IRA rules.
All right. Gotcha.
There it is. There's the money shot. That's what I was trying to get everybody over to. So between the HSA and the non-qualified the inherited, I mean, that's a huge opportunity right there. If everybody's focusing on all those conversations at that time, this should come up. This should come to mind.
Especially right because I think what's going to come up in a lot of people's minds right now going into the year end especially for those that have to take RMDs, that's going to be top of mind. And are they looking into Roth conversion strategies before the year ends? Because I find it very interesting. You know, when people are looking at their retirement accounts, they're always caught up on the fluctuations of the value of the assets. But very rarely do they realize that the fluctuation of their tax brackets from not just what taxable bracket that they themselves are in, but from how government policies change from year to year, how it's like, okay, you might have been in a 20% bracket this year, but next year you're going to be in the 25% just for how the rules changed and what have you. Like that fluctuates almost just as much as the market. We've got to be having these conversations because our clients need us to help them. And I'll encourage you, if you're taking anything away from this, the two key things of sense of urgency is planting the seeds with the plan of care because of the high probability of your clients experiencing it. It's being at the right place at the right time. The second is this is a prime time to talk about using qualified funds in some way, shape, or form for clients going into the end of this fiscal year. Uh, you can wait another 10, 11 months to catch it next year, but why not do it now? Why the time is right. Again, work smarter, not harder. Seize the opportunity.
No, you're pushing the right emotional buttons at the right time of year, right? Everybody should be talking about estate planning from here to the end of the year, and this goes hand in glove with estate planning. I mean, this is why Jordan's on today, because Clayton and I have been reviewing, what do we push towards the end of the year? It's the estate planning, folks. Everybody's gathering around the dinner table. Who showed up to Thanksgiving dinner? Who didn't? The naughty and the nice list, right? So this is the time to have these conversations. It really is. It pushes the right emotional buttons and creates the right emotional solutions.
Awesome. Well, one of the things I'll do in my follow-up, Peters, I'll send you and
Can I ask you a
Clayton.
question, Jordan?
Yeah, go ahead.
I've got a couple of 87-year-olds, and I've done the wills and estates thing, but I'm wondering what type of, and they don't have any long-term care. What would you be, what would you look at?
So the only thing that they're going to have available to them, we have to fund it with a lump sum of non-qualified funds. There are 3 assets that we want to look for.
That's what they have is non-qualified.
Beautiful. First is going to be non-qualified annuities. If they have a non-qualified annuity, slam dunk, because we can reposition that. So let me see so we can reposition it so that every penny will pay out tax-free for long-term care. So what you're seeing on the screen is the visual there, that essentially if they can pass 4 knockout questions, we can instantly set it up so that every penny of that will pay out tax-free for long-term care. The second asset that we're looking for is if they have cash value life insurance where they don't need the death benefit. They will give up the tax-free death benefit, but it will provide them living benefits that'll pay out tax-free, as well as give them access to the claim concierge service. The third funding source, and I'm kind of breezing through this. Michelle, make sure you send me an email so I can send you a summary specifically on this opportunity. I'm going to be looking at index annuity care. And here's an explanation of the number. So the third funding source is a lump sum of cash or cash equivalent. Because think about, especially right now for where interest rates are at, interest rate market, I would venture to guess everybody could easily agree that it's going down. It's not going up anymore. It's going down. So interest rates on savings accounts, you're getting about 2 to 4%. When you factor in taxes, it's really a net closer to 1 to 3%. So this particular solution is called index annuity care. It's going to grow by about 2 to 4% depending on the crediting strategies tied to the S&P 500. I'd probably pick the fixed guaranteed for these clients, which is just under 3%. But when you factor in the increased growth for LTC and the tax-free distributions, it's an additional net of 2 to 4% on top of that. So a total take home of 4 to 8% if used for LTC. When you think of from an investment standpoint, for someone that's 87, they're already past the higher end projected claim age. They're winning the race, but 87 is the max age that we can write them. So it's either this or nothing. So what I'd say is I'd love to get their info. Shoot me an email with their info. We'll put proposals and talk about the value added. The question is just figuring out what non-qualified asset we want to use to fund it.
I hope everybody is paying attention to the death benefit. There is a death benefit on here. So if they don't use it, they didn't lose it, right? It still passes on to the heirs, and it's going to grow, like you're saying, it's going to outpace the current interest rate environment if they kept it in a CD or if they kept it in at the bank. So there still is a death benefit.
Absolutely. So one of the things that I'll kind of state to our plans, it's not a question of if they will pay out, but when and to who. 3 ways they can pay out: quit, live, die. You could live and need live, quit, die. You could live and need long-term care benefits and the contract will pay out. Or if life happens, you can always quit the contract and walk away with the money at any point in time. But if you never use it and you pass away, there's a death benefit that would pay out to the beneficiaries. In this scenario, it's not tax-free. It would be taxable given whatever the gains were in the contract. But still, it's not like it's lost money.
Not if they're smart and put it into their own One America accounts, right?
Yeah. But perfect. Michelle, yeah, send me info on the client that you're working on. I'll make sure I'll get my contact info up there.
Yeah, I got it. Jordan.fields@oneamerica.com.
And what's nice about that too, Is this a joint, husband and wife?
Yes.
So we can actually, even if we're using a 1035, we can use one person's assets and get coverage on two people. So take like the life insurance scenario. Let's say the husband has cash value life insurance on himself and they don't really have a need for the death benefit. We can still do a like to like 1035, but add the spouse on via what we call an eligible person rider. So they'll look, act, and smell like an insured annuitant, but technically they are not for 1035 purposes.
And
We got
that
a little bit
loophole
more.
is so powerful, everybody. It really is. Like Jordan was talking about earlier, for business owners, especially those of you who are working that arena, you pay for one, you get the benefits of two, right?
Mhm.
So an owner and their spouse, right, with the contributions from the 162 benefits, the tax advantages, they both can benefit from that. So I mean, that's a doubling effect. So if the Cobb benefit is $8,000 for one, it's 8,000 for two. Is that correct, Jordan?
Yeah. So in other words, they would both have equal access to that benefit on that. So yeah.
I'm sorry.
Awesome.
I'm excited about this, guy, because the more every time I come back and I review, the more opportunities. Like I didn't realize you could use the HSA money, and I know I've watched this presentation at least 4 times, but I didn't catch the HSA opportunity. And now that I'm seeing the inherited opportunity, those are 2 more times where Clayton and I. There's not a lot of carriers out there that handle inherited IRAs, right, Clayton? Or
Oh, I come
right?
across non-spousal inherited IRAs all the time. And knowing I could take that over to One America, phenomenal. Uh,
Huge. So I'll plant the seed with uh, non-spousal inherited IRAs. If you have clients that have copious amounts of qualified funds and you know they're going to go ahead and gift it to the next generation, do it proactively. You can actually, I'll give you a scenario here. Scenario, and I
okay.
probably need to wrap up because I'm probably going so far into the weeds, but I love this one. So 3 generations. We have the grandparents that are taking RMDs, we have the kids, and then we have the grandkids. So one of the things that's unique in that combination, my family's guilty of this as well too. The grandparents, they like their kids, but they love their grandkids. They're not looking to give their kids any money. They want to give everything to the grandkids. So my mom's buying dresses, all this hoopla for all my kiddos and what have you. And so one of the ways that you can talk about families like this that have a lot of qualified funds is you can use the grandparents' qualified funds to get LTC coverage on the kids and then name the grandkids the beneficiary on the life insurance contract. So here's what you're doing at each level. For the grandparents, you're helping them meet their RMDs. You're being proactive on it from that wealth transfer. You're getting LTC coverage for the kids. And then you have an inherited legacy that if it never gets touched, that'll pay out to the grandkids there. And
Huh.
I love that solution. Because when you think about what's going to happen with the baby boomer generation, the wealth transfer with qualified funds, when people inherit these qualified funds and are forced to take the distributions out over a 10-year time period, is everybody going to go on a 10-year sabbatical because of the tax ramifications? I feel like I'm taking crazy pills and I'm like, people, we need to be looking out for this because like what? Is it gonna be like, yeah, I'm not gonna work for the next 10 years because I'm not gonna pay 50% of my inheritance to the government just because of poor timing from a tax standpoint. We've got to be proactive and help our clients have better conversations. And what I'll tell you is don't assume that your client has a plan in place. Just ask them, have conversations. Hey, have you thought about this? You'll be surprised what has happened. And Michelle, we want to move fast on those 87-year-olds because once they turn 88, we got nothing for them. So especially if they have birthdays around the corner.
No, they're in June and May, but I'll
Perfect.
work on it.
We have some time, but just you never can get in the way sometimes. So yeah, shoot me an email. I'll shoot you information. If you give me client's name and what I'd say is, let's just say we start off with 100,000 from a dollar amount. Our benefits are linear, meaning if we double the premium, it'll double the benefits, and if we cut it in half, vice versa. This is a fun group. I always love having these conversations with y'all because you guys keep digging, prodding, and uncovering things. So always love to help out however I can. So I'll encourage you, have these conversations and let us know how we can help.
Hey, how
Hey,
much
Jordan,
on the
go
87
ahead,
year olds, how
Michelle.
much would I get commission for?
So street level, am I okay to give that number? 2.5%.
That's pretty good for an 87-year-old.
That's really stinking good. If you would have gotten them a year earlier, it would have been 3.5. In 2 years, it would have been 4.5.
Hey, Jordan, would you have that multi-generational strategy on drafted up on like a handout or a
Yeah,
slide or
there's a
something? Because
flyer
that is
somewhere
damn
where,
impressive.
yeah.
Yeah, we could
Uh,
create a marketing piece behind that and send that out to a lot of people. The generational, a legacy of love, generational marketing we could do on that.
I'm pretty sure I got a sales flyer on that somewhere that I'll hunt down and send to you.
Cool.
I'll send you guys a recap of the things that we chatted about today. That'll have some of the necessary marketing pieces. Um, but yeah, I'd say one of the big things that we didn't even touch on today, we can save this for as needed or when we get into a case, is the claim concierge service. Like that's one of the biggest value added and probably most undersold benefit because it's not quantifiable. What I'll tell you is we have a fantastic video that I'll highly encourage showing that to clients. It's client approved to help them understand what that value added is. A lot of times when people see this client video, they're like, this is why I work with One America, or this is the reason why I want this solution, this right here. Very, very, very powerful.
If you can get us the marketing slick for the generational stuff, and we include the video on the landing page for that,
Yeah.
that's a 1-2 punch right there.
No,
Either I'll find it in like
that's
less
some
than
very
15
outside the
minutes or it
box
might
stuff.
take me a couple hours. So yeah, it exists somewhere. I'll be able to find it. I'm not too worried about it though.
Does anybody have any questions for Mr. Jordan while you're on here? I mean, I know Christy, you've not said anything. You've got to have at least one question.
I'm just taking it all in because I have a couple. I mean, even the one that we're looking at, Pinot Boutique, with the mom, I was thinking that that was something that we
Exactly.
can offer, especially since the husband currently has, well, I guess that's one of the questions I have is with the long-term care, and you're talking about it can cover both, right? He is battling cancer. It's like he was in remission and he recently came back. So in something like that, where they like, let's say one spouse has an issue or health, how does that affect the insurance? And is that something that they can both cover? Because right now she's in good health. She is overweight, for her like her BMI, I guess, or her height to weight ratio, but she's in
Mhm.
good health. She's still working. She's in her 70s. And the husband, I mean, and he's in good health considering, other than, he is on the cancer, but he's not like bedridden or anything. He's like walking around. They just came back from vacation. So is that something that could cover both of them?
Yeah, I just want to gather a little bit more information on that front. What I'll tell you is that we basically have three tiers of solutions. One is our life chassis, which is better suited for clients under the age of 70 that are healthy. We have a leveraged annuity that's more for 70 plus or clients that have health challenges. And then that base annuity, the one where they only had to pass 4 knockout questions, uh, everything you said, they would not be ineligible for that solution. Not sure if that makes sense in that scenario there, but where I'd want to start out there is assess their health to see what it would come back from that. Chrissy, if you shoot me an email so that way I know I have your info, I'll send you the pre-screening information and we'll see what underwriting says and figure out what is or is not available to them.
Okay, and then also another question I'm at, and this is just something in general that I was having in regards to fixed index annuities. How are you guys offering a guaranteed rate when like the market is like drop, like the Dow Jones has been like this week has been like really rough. Like, how are you guys able to offer those rates when the market is down? If it's like looking at the market, does that make sense? Like, is that something that, do
Yeah,
you have
so
something set?
if you were comparing our interest rates, whether it's the fixed guaranteed or the caps and pars on the index annuities, you're going to find better elsewhere. Mainly because we're not our interest rates are not designed to be flashy. It's designed to say, hey, when you put this in force, we are going to live up and provide those numbers on the back end because we know typically one of two things are going to happen when people go with our contracts. They're going to pass away never using it, or they're going to access it for LTC. So we need to provide numbers that we feel comfortable with. And it's not like you're, and please don't take this the wrong way as I'm talking about other annuity type carriers. They're designing their numbers to be flashy. They want to have a rate to kind of pull you in and lock you in for that surrender period time period, knowing that you're probably going to transfer 1035 it elsewhere after that time period. So evading that hot potato. Whereas for us, we know we're going to keep those assets more times than not.
Well, the other part, Christy, is remember they have life insurance and annuities. Any organization that has both, there's a profit margin off of the life insurance aspect. That's an internal profit margin to the company. So the actuaries figure out what their profit margin is versus the loss, the large number of law of large numbers, right? The mortality lost. And so they know what their profit margin is to offer those rates. Do you have the materials in Spanish, Jordan?
Spanish. Thank you for asking. I did not write that down. I will go look for that Spanish.
I know Mr. Rodriguez, we got a couple of there. Mr. Orantes would love to have that.
Yep, I will. I know that we do have some. I don't know off the top of my head what things we do or don't, but we'll figure it out.
Very good. Any other questions?
Yes, I'm meeting with a client tomorrow. They're Spanish speaking, and they own some properties that they may have to sell once I plan the idea that the husband is getting pretty close to needing long-term care. He's still coherent, but his cognitive skills appear to be declining. And so unfortunately I had the opportunity a little bit too late, because instead of reallocating their assets, cash assets, they purchased another home. So, but at least, I'm gonna see if I can reposition the sale of one house dedicated to long-term care, and knowing that they have a death benefit too. But that's the reason why I need those materials in Spanish.
Absolutely. Shoot, Jorge, if you'd shoot me an email, specific, just saying, hey, will you send me the material in Spanish when we finish here? That the things that you guys have tasked me as stuff you're looking for, that'll be my top priority to get knocked out and sent to you before the end of the day.
Will do.
Awesome. Well, appreciate the time. You guys gave me some good work to go back and get back to you all. I'll follow up with that and send that. I'll make sure Peter and Clayton, I'll disseminate that to you all to relay to the whole group, especially the sales idea for the gifting strategy. I know we have something. I just got to figure out what the file name is and what have you. So I wouldn't say it's a needle in a haystack, but I know it's in this haystack and what it looks like. It's a little bit bigger than a needle. So one haystack that I'm looking at.
Perfect.
Awesome. Well,
Good.
I'll thank you all for having me on for today's call. Whatever we can do to help, please don't be strangers. Your clients want you to talk about this. It doesn't have to be One America. That's okay. We'll help you however you want.
We appreciate it, Jordan. Thank you so much. And
Jordan.
Look, very, very powerful stuff today there, folks. That whole multi-generational planning idea there, that's fascinating to me, considering I'm doing quite a bit of work with the third generation of a family I've been working with for over 15 years. And so, that to me is the type of stuff that's a niche sale, but that's the type of stuff I love learning about in this business. So I appreciate that. And go ahead,
when
Peter.
Jordan gets us the information back, we're going to work on a custom marketing piece. But for those of you who are thinking about how could I deploy this, Lead Concepts has a mailer specifically for long-term care needs. So if you're not aware of that, they've got a mailer out for long-term care needs to send out to clients. So if you're looking for some active marketing you could deploy tomorrow, you're going to cost you $1,000, $2,000 to get some pieces out there, but you could literally have some business in before the end of the year, specifically with One America and long-term asset-based care. Maybe if you're smart about it, you'd also pitch the estate planning on top of that, just as part of the whole package. But if you're looking for something, once again, that was Lead Concepts is the group that has a piece out there right now.
Cool.
You have their number, or
I'll have to email you our contact over there so he can get that for you. Yes. I apologize. I don't have it memorized. I'm trying to do good to keep up
come
with
on,
everything else.
Peter. This is the only thing that you don't know is the man's phone number, or at least his name.
Yeah, well, we went through 3 different support staff members over there that they rapidly, one retired, the other one got fired, and then we wound up with
Oh
somebody else. I
dear,
can't remember which extension is it now. So
that's fine.
thank you
Do you-
everybody for joining us. Thank you for joining us. I hope everybody has a blessed weekend.